Hello, friends. August just got more expensive for a lot of retirees, and most of them have no idea it happened. Not because of a new tax that Congress passed with headlines and debates, not because of a dramatic policy overhaul that generated weeks of news coverage, because SSA quietly updated guidance that affects how Social Security benefits interact with federal income tax calculations. And the result is that a meaningful number of retirees who were not paying federal income tax on their benefits, or who were paying it on a smaller portion than before, are now sitting inside a threshold they did not realize they had crossed. More of your Social Security may be taxable starting now. Not might be, not possibly, is. For the retirees the August update applies to, the tax calculation changed, and the deposit they are building their budget around does not account for the additional tax liability that is silently accumulating alongside it. I am going to tell you exactly what changed, how Social Security benefits become taxable in the first place, which specific situations are now producing a larger taxable portion than before, and the specific actions available right now to manage this before it compounds silently through December and lands as a surprise in April. Stay until the very end. The last situation I cover is the one where the gap between what retirees expect to owe and what they actually owe at tax time is the largest. And if SSA Now is the channel that catches what SSA updates quietly and explains what it means before it affects your finances, subscribe right now and turn on the bell. Let me start with something most retirees were never clearly explained: how Social Security benefits become taxable. Social Security benefits are not automatically tax-free. They became taxable through a formula based on what the IRS calls combined income, also known as provisional income. Combined income is calculated by adding your adjusted gross income,
tax-exempt interest you receive, and 50% of your annual Social Security benefits. The resulting number is compared against two thresholds. If your combined income as a single filer falls between $25,000 and $34,000, up to 50% of your Social Security benefits may be subject to federal income tax. If your combined income exceeds $34,000 as a single filer, up to 85% of your Social Security benefits may be subject to federal income tax. For married couples filing jointly, the thresholds are $32,000 to $44,000 for the 50% tier and above $44,000 for the 85% tier. Here is what makes this particularly punishing. These thresholds have not been adjusted for inflation since they were established decades ago. Cost of living adjustments to Social Security benefits, the COLA increases designed to help retirees keep pace with inflation, push more retirees over these unadjusted thresholds every single year. The COLA that was supposed to help you keep pace with rising prices is simultaneously the mechanism pushing more of your benefit into taxable territory. Now, here is what SSA's August update changed and why it matters right now. SSA's August update revised internal guidance around how combined income interactions are calculated for retirees whose income picture changed during 2026 due to specific triggers. The update identifies 3 situations where the taxable portion of Social Security benefits is now higher than before, and where retirees who have not adjusted their tax withholding are accumulating a liability their current withholding is not covering. The first situation, retirees who received a benefit increase this year and crossed a combined income threshold for the first time. If your Social Security benefit increased this year because of the annual cost of living adjustment or an earnings-based recalculation, that increase may have pushed your combined income across one of the taxable thresholds. A retiree
just below $25,000 as a single filer may now be above it. A retiree in the 50% taxable tier may now be in the 85% tier. The benefit increase feels good in the deposit. The tax implication of crossing the threshold does not become visible until tax time, when the retiree discovers that a portion of the benefit they received all year was taxable income, and their withholding from the year did not account for it. The result is a tax bill they were not expecting on income they already spent. SSA's August update specifically notes that retirees in this threshold crossing situation should review their current tax withholding and consider a voluntary withholding adjustment. The mechanism is Form W4V, the Voluntary Withholding Request Form. Submitting W4V to SSA allows retirees to have federal income tax withheld directly from their Social Security benefit at rates of 7%, 10%, 12%, or 22%, depending on estimated liability. This is voluntary, but for retirees who crossed a threshold this year, it is the difference between a manageable monthly withholding and a surprising lump sum bill in April. Download W4V at irs.gov or ssa.gov and submit it to your local Social Security office. The withholding adjustment takes effect within a few processing cycles. Drop a comment right now and tell me, do you currently have federal income tax withheld from your Social Security benefit? Because I consistently hear from retirees that they did not know voluntary withholding was available. And for the people the August update applies to, that option is the most important financial adjustment they can make this week. The second situation, retirees who took a required minimum distribution this year and the RMD pushed their combined income into a higher taxable tier. Required minimum distributions from traditional IRAs, 401ks, and other pre-tax retirement accounts are included in your adjusted gross income, which goes directly into the combined
income calculation that determines what percentage of your Social Security is taxable. For retirees who turned 73 this year and are taking their first RMD, or for retirees whose retirement account value grew enough that their RMD increased significantly from last year, the addition of that distribution may be pushing their combined income across the 85% taxability threshold. The interaction is one of the most consistently overlooked sources of unexpected tax bills for retirees. The RMD is taxable income on its own, but its interaction with the Social Security taxability formula means it also increases the taxable portion of the Social Security benefit, creating a compounding tax effect larger than either item would produce independently. SSA's August update specifically identifies RMD interactions as a trigger category for retirees whose combined income changed significantly this year. If you took your first RMD this year, or if your RMD was substantially larger than last year, recalculate your estimated combined income for 2026. Add your adjusted gross income, including the RMD, plus any tax-exempt interest, plus 50% of your annual Social Security benefit. Compare that number against the thresholds. If you are now in a higher taxability tier than last year, adjust your withholding or estimated tax payments before December to avoid an underpayment penalty. If you work with a tax professional, this is the conversation to have before the end of the third quarter, not at filing time when a year is already closed and the liability is already set. The third situation, and this is the one I told you to stay for, retirees who received retroactive Social Security payments this year as the result of an approved appeal or benefit correction. When an SSA appeal or reconsideration is approved and produces a retroactive payment, a lump sum covering the months between when the correct benefit should have started and when the correction processed, that lump sum is taxable income in the year it is received. The entire retroactive payment arrives in a single tax year, even though it represents benefits that accrued across multiple prior years. The tax impact can be significant. A retroactive payment of $4,000 or $5,000 received in 2026 increases combined income substantially, potentially pushing the retiree from below a threshold to well above it for a single year's calculation, even though the income represents a multi-year correction. SSA's August update specifically addresses this situation and flags it as requiring immediate tax planning attention. There is a provision in the tax code, often called the lump sum election, that allows retirees who received a retroactive Social Security lump sum to calculate their tax liability as if the benefits had been received in the years they accrued, rather than all in the year of receipt. This calculation can significantly reduce the tax impact of the retroactive payment in cases where spreading the income across prior years would have produced a lower combined income in each of those years. The lump sum election is calculated using IRS Publication 915. A tax professional can complete it relatively quickly with your prior year tax returns and the SSA statement showing how the retroactive payment was allocated across prior years, which SSA provides on Form SSA 1099. If you received a retroactive Social Security payment this year, do not simply add the full amount to your 2026 income without investigating whether the lump sum election applies. The difference between filing without the election and filing with it can be hundreds of dollars in federal income tax on a single retroactive payment. Here is the thread connecting every situation SSA's August update identified. All three involve retirees whose 2026 Social Security income picture changed in ways that affect their tax calculation and whose withholding has not adjusted to reflect that change. For all three groups, consequence of doing nothing between now and December is a tax liability accumulating all year that arrives as a surprise in April when the options for managing it are significantly narrower. The options available right now, voluntary withholding adjustment through W4V, quarterly estimated tax payment adjustment, and lump sum election analysis for retroactive payments are the tools that prevent April's surprise. All three are documented. All three are accessible. None require a lawyer to initiate, though professional guidance is worth pursuing if your situation involves multiple categories simultaneously. So here is what to do right now. Calculate your estimated 2026 combined income, adjusted gross income, plus tax-exempt interest, plus 50% of your annual Social Security benefit, and compare it against the taxability thresholds. If you are above $25,000 as a single filer or $32,000 as a married couple, a portion of your Social Security is taxable this year. If you crossed a threshold because of a benefit increase, submit W4V to start voluntary withholding. If you took an RMD this year, recalculate where that addition places your combined income and adjust your withholding before the fourth quarter. And if you received a retroactive SSA payment this year, obtain IRS Publication 915 and determine whether the lump sum election reduces your 2026 tax liability. The August update is hidden. The tax liability it creates is not. Act now while the year is still open and the options are still available. If SSA Now gave you a warning today that would have cost money to get anywhere else, subscribe to this channel and turn on the bell. Every hidden SSA update, every tax interaction that builds quietly through the year, every financial consequence of what SSA changed without explaining, I bring it here before April arrives with a number you were not expecting. And share this video with every retiree you know right now. The August update applies to their tax up.
Picture 2. Whether they find out today or in April is a difference measured in real dollars. I will see you in the